I wish that I'd been taught when I was at school. I'm an investor, a business owner, and a money educator. Understand it better, compound interest, cash flow, budgeting, investments, recover from debt. No one explained to me, put your money to work. It's about normalising the conversation. Hey everybody, welcome back to the Money Mechanics podcast. We are joined today with Komey. Komey's a friend of mine, contact of mine that I've had in my life for a very long time. So Komey actually went to school with my sister in Milton Keynes, and we have known of each other for a very long time. We've done business together, we've crossed paths, we've traded together, we've done all sorts of stuff together over the years. And Komey has come on the podcast because where he's at now in life is very different to where we started off, and has very recently launched his hedge fund, which is really very exciting, which is called Zentra Capital. And today we're just going to be talking about the journey from one place to the other and all the stuff in between. So Komey, do you want to just introduce yourself, who you are, what you actually do?
Hey guys, yes, so I am Komey Tetteh. I am a portfolio manager. I've been trading the markets for many years, and as Sarah just mentioned, recently launched my own hedge fund. I've been trading for a hedge fund since 2018 and got on the license in 2021. So I'm old in the game. Everything I do is around money. It's around how can I extract more from the markets primarily? And I have been on this journey since 2011. So it's been a while.
Been doing it a long time.
Yeah.
What do you think makes you successful in this space?
In this space, in the trading space, it is, I would say, my number one thing is I make sure that I don't know what's going to happen next. So that's my number one thing, is I trade knowing that I have zero clue what's going to happen tonight, tomorrow. If you ask me where I think the market's going to go, I don't know. And that's the number one thing that keeps me grounded, because I'm able to build systems in the unknown, in the gray zone. And I've lived in the gray zone for a very long time. So by understanding I have no clue what the market's thinking, I'm able to build systems which work in random environments. And that's how it's. So
amazing.
That, stay humble. We all have the God particle that pops up every now and again.
Every now and then.
We're picking, we think we know what's up. And then the market soon humbles us. So yeah, I've been through all the humbling experiences earlier on, and I just kind of learned from that and just said, okay, I don't know. It's the answer.
So to give people context of the sort of money that you are working with on a day-to-day basis, how much money do you manage inside of the portfolio that you're responsible for at the minute?
So at the moment, it's about 13 mil USD. And that's with another fund. And I am... That's in the CFD space. So CFDs are, if you've used some of the retail brokers, you have Forex, you have indices. So the CFD space, but I had a major problem with that. And I kind of got disheartened because you hit a ceiling and I couldn't build a system that could generate alpha beyond that, because I've hit the maximum limits of everything. So imagine you're earning for your clients 1 million a year, and that's all they'll earn, regardless of whether I have 20 million or 30 million, it's always going to be 1 million a year. So then your performance actually dips, your net ROI. So that just didn't really work for me. So I wanted to move into the big boy leagues where you can trade billions. And that's where we've gone now. So that's why I launched Zentra, because we trade these assets. And I'm now able to manage much larger numbers, and
which is amazing.
Looking forward to it. Yeah,
it's so exciting. I'm so excited for you.
Yeah.
So
thanks.
Talk to me a little bit about kind of what you thought you were going to do, like when you left school, that kind of part of your life, and where you thought you were going to be ending up, and what has been different in the end.
Yeah. So when I left school, where I thought I was going to end up is where I ended up. wearing the nice blue suits, going on the train to London, the capital city. You've got your tie on and you're working for a big firm. And that's what I studied for. So I went to university, I did a couple of degrees. I was there till forever because I just kept studying accountancy, computing, and wanted to work for a big four. So I managed to get into the big four, got a good job, stable, steady, solid company, unlikely to go anywhere for a very long time. And I was there for a total of about 10 years, 11 years. But by year 5 is when it started clicking that perhaps the 9 to 5 is not my calling, just because there was always more month at the end of my money. And then we know the debt cycle begins because you've got enough to live, but then you don't have enough for the surprises that pop up. And the boiler breaks. So that's a credit card. So when these things were happening, and sometimes they happen back to back to back, I just saw the equity curve going down and down. And then one day I just saw this guy in a Ferrari, and I wondered,
what does he do?
It's always that. I don't know what this guy does. Then you start researching, and I start looking into how can he do this? Because when I was growing up, my mindset was a 50K a year salary was the peak. I was happy to retire on that. But I'd never seen that number because I was on maybe, I don't know, 30K. So I thought, if I'm on 50, I'll be comfortable. I can go on my holiday a year. Then came that website, salary calculator. Salary calculator, where you can see after the deductions and your student loans and all that kind of stuff. Woof, I put in 50K and I thought, well, can this get me that car? And the answer was no. So
definitely not.
Exactly. So I kept going up and up and up and up, and it took me to close to about maybe 200K, and you get taxed 50%. So then that's 100K net, and the car's going to cost you $2,500 a month. So then I was thinking, it's still not really making that much sense. There must be something. How is it working out? So then started a journey of self-discovery, self-learning, and that all happened from age 28 onwards. Because by 30, I thought, okay, I didn't expect to be broke at that age. So definitely went along the formal route first. Mum was happy, graduated, everyone's happy, got a good job, everyone's happy. And then at some point, it just didn't feel like it was going to be enough. So I had to research and find out what is out there. And I looked at property, but at that time, there weren't many people who taught property. There weren't many people taught many things. Internet was still kind of newish. So at that time, the only property things I saw would cost you an arm and a leg, because the moguls were all, the Donald Trumps and everything that seemed like big money. And
big money,
I didn't have anything greater than £300 available at any one time. That was like the peak of my wealth. So I kept researching, and I found stocks, and I said, well, how can you invest in stocks? And I found a broker that said, oh, you can invest £50, £100. And that was the journey. I said, well, I'll just get started with this. It's at least I'm involved in it. So then that got me on a journey after the suit and tie.
Okay, a very short interruption of the episode, so I want you to get back to listening. I just wanted to remind you that the Money Mechanics weekly newsletter is completely free, and we'll send this out to you every week. All you've got to do is find the link in the show notes and get signed up. When we send this out to you, this weekly newsletter is going to include things that will help you to become a better money mechanic. It could be things like what's happening in the markets, things like budgets, how that's going to impact you. And I'm also going to share a lot of insight into what I'm doing in my own portfolio and in the portfolio of the guests we've got on the podcast, to really just help you understand what you could do differently to make your money work as best as it can for you. Make sure you go and find that link and get signed up.
So did you start trading stocks for yourself, like with £50 at a time, £100 at a time? And then what takes you from there to having a hedge fund? Like, did you then just start trading for other people because people saw your success and they started to ask you, can you work with my money? And it kind of went from there, or did something else happen?
So the journey was, I started off with £50, and I didn't really know the difference between investing and trading. I tried to get help. I couldn't find it. I was actually searching for someone to teach me. Then I ended up just placing a random trade, and I made, from that £50, it turned to £400. And I was made. I thought, this is it.
Done. This is the one.
I've got the formula. I know what to do. And then I told my sister, because you have to take the money out and spend it. So I took it out and spent it because it was just on a screen and it's real. So now I know I can make money with this thing. And I started a day job. I had a day job for the first 5-6 years of my trading career. So I started a day job, and I placed a trade in the morning, came back a couple of days later, it was money. So I thought, oh, great. And after that, I lost for 2 years straight, every month. But
for 2 years, that's some going, because most people are lose for 1-2 months, and then they're like, oh, this is shit, it doesn't work. So 2 years, that's a long time.
It's a long time to lose. It's a long time to just keep losing. But the thing is, every single time I would build a new strategy, I'll build a new system, and it works for a bit, then it stops, and I lose everything, and it works for a bit, and it stops. So I just lost for 2 years straight. But I knew, which is the question that I need to think, would I have continued? But I knew that I had made that money initially. So I knew it was possible.
Yeah.
It was possible. If I had just lost for 2 years straight, would I still be here? I don't know.
Isn't that interesting?
It's a very interesting question. But because I knew it was possible from trade one, I'd not won since, but I just thought, well, I just need to figure it out. So after year 2, I finally figured, okay, risk is important. I need to manage that and now to look after that. Then I thought, well, I still only got £1,000 to my name. How do I manage? How do I get more to me? And the answer was OPM, other people's money. So it was how do I then get other people's money, trade that, take a percentage of profits, and build my personal wealth. And that got me on a journey of friends and family type account. So I just started managing friends and family funds. And I did that for a few years. And that helps me build a track record, which I was then able to present to institutions and say, right, I've got 3 years, I've got 5 years. Can you sponsor me or give me some more capital, etc.?
Yeah.
That took me on a journey. And at the time, when I first started to trade 1-2 million, that was a pipe dream. That was just like, whoa. So
how have you got there?
I know. When I saw those numbers, it was crazy. It was crazy. And I remember the fear that was in me, because then you start doubting yourself, your systems. When you're losing 1%, 2%, you're seeing thousands being lost. So I had to build systems to help with my psychology on that, because I just couldn't see myself lose $5,000 in a day, thinking I start my day job and it'll take me 2 months to earn that.
Earn it, yeah.
Yeah, I literally just lost it in a day. I thought, oh, okay. So I had to build systems where I didn't see the actual balance. I just saw the percentages.
That's wise. Yeah, that's good.
Yeah. I just see,
when you talk about building systems, so for people that are new to trading, new to this sort of business, when you say I built systems that did X, Y, Z, what exactly do you mean by that? Is that a process of analysis? Is it a piece of tech? Like, what do you mean by that now?
Both. So there's manual systems and there's automated systems. Everything will be based on an if this then that statement. So it's, if this happens, then I do that. And so I would have a look. Initially, it was pure technical analysis, chart patterns. So it will be, if this pattern happens, then I'll do this. And
so if something goes up to a certain price, we will sell or we will buy.
Correct.
So basically, just very simple. Okay, cool.
Yes. So that was a very, very simple, high level, if this, then that. If the market was higher than it was yesterday, then I buy. And if it goes lower, then I sell, or then I do a stop loss. And so it was just that in its base form. And then we go deeper and deeper and deeper into it, to the point where we start looking at micro movements in the markets. But it's, if the market does this and this and this and this, then I'll do that. So then that was the manual process. And I thought, okay, well, can this be automated for testing to visualize? Yeah. Then I jumped on a whole journey in automation trading, built hundreds of thousands of strategies with this if then that system, with all indicators you can imagine. Indicators are something that help you visualize the chart in a different way. So it's representative of the chart, of a trading chart in a different way. So I'll then use everyone, and I built thousands of systems, and yeah, it was a very, very fun time.
So nowadays, because I know obviously when you started this, it was all quite manual. So you'd have had to write those, if this happens, do that. Yeah. Are you utilizing AI now to help you to model those things differently than what you used to, or are you still doing it the way you did it?
I don't use AI in trading per se. I use it more just to analyze historical data.
Okay, cool.
The way I trade, I would say, I see a lot of stuff online saying, "Oh, we've got AI that works, and we've got AI that works," and I think, well, if you have AI and I've got AI, someone has to lose. Whose AI is going to lose? So I use it more just to model data, and the way I trade these days isn't dependent on market direction. Everything is neutral. So I'm just, if it goes up, if it goes down, I'm looking to make money in all directions. And that's uses certain market internals that are consistent, like volatility, like implied volatility, like
assuming that the market will wobble about, you make money up or down.
Yeah, exactly. So regardless of where it goes, we're looking to generate profit. We make money for being in the market, like time in the market. We receive in options, it's called theta. So for every day we get paid for being in the market, and we're able to get somewhat predictable income with this. So I use systems now that have more of a predictable outcome. To the point where we can hazard a guess at around 95% accuracy on our trades, and I think, great.
That's pretty impressive.
This is good to work for large funds, and I say that, but we still need to manage risk, right? Even if I would say it's the law of large numbers. Yes, we have a 95% probability of profit, but you will still lose 5. So if I don't manage my risk properly, I'll end up in a place that I just don't want to be. So your risk management strategy is actually one of the things when I tell friends about you, and I talk about, like, I know Komey, this is what he's done. I was telling my friend recently that you've just launched a hedge fund. We're having a chat about you in Ibiza, actually. And I said, the thing that I find really great about Komey is that his risk management strategy is different from anyone else that I've ever met in this space, because most people that I meet who are trading big amounts of money or are launching hedge funds or doing anything in this space, they're very cocksure of themselves. They're very loud. They're very kind of, we know what we're doing. We can predict the markets, that tone. And you are such the opposite of that. Like when you meet you, you're not flash at all. You're a very humble man, which I think is like one of the reasons I love you so much. But you're also someone that tells me often and tells people, like you say, we assume it will go wrong. So we always make sure that we've mitigated the downside as our first priority. And then if we make money after that, then that's a bonus. So talk me through what risk management means. I know what it means, but for people that are listening to this who've like never really done any sort of trading or investing, what is risk management and why is it so important? So risk management is how much are you prepared to lose? It's how do you manage the downside of your portfolio? We love it when the market goes up, but it will come down at some point. So it's how do you manage that downside? And you are able to do it in various ways. You can place what you call protective stop orders. So if the market moves X% against you, you automatically come out. You can run hedges, so you can hedge in the same market, other markets. You can run a kind of market maker type strategy where you would go long one, short one to neutralize the position. There's many ways of doing it. The easiest way is just to run a stop order. So risk management is where you as a trader or individual will have your own mental stop where you say, this is enough. I'm not going to go anything lower than this. I will pause, I will stop, I will turn off my computer. That is the most important thing when we're trading and when you're managing other people's money. So when I talk to people about trading or my investing, I always talk about what capital can I protect. So out of the 100% you give me, I will protect X% of it because I am certain to a, call it 98% probability that you will never lose more than that. There might be some crazy, it needs to be a crazy market event. I'm talking worse than 2000 COVID crash, right? It's very, very bad for us to miss that. And if we do miss that, it'll be by a very, very small percentage. When I build my portfolios, it all has hedging built in anyway. So when the market drops, we do all right. So the whole point of being neutral is if it drops hard, we do well. If it goes up, we do well. So it's just needs to range and just not do anything too crazy too quickly. Like Donald Trump's tariffs recently, right? Markets crashed, they spiked. We're still okay even in that environment. So I've built the systems with risk first, knowing what the max loss is going to be and what I can tolerate. Because with risk comes the reward. And one metric which a lot of people don't look at, it's called the Sharpe ratio. A Sharpe ratio is a risk-adjusted returns. And this is one thing that you need to ask anyone who wants to manage your money is, what's your Sharpe? And the majority of people, retail guys, won't know what that is. But risk-adjusted returns, SHARP, Sharpe ratio. And if you are a fund like myself, we need to see above 2. Essentially, all that means is, what are the returns versus the risk? Because if you come and tell me, oh, I generate 200% return per year, but you have a Sharpe of 0.5, it means I'm going to lose my money at some point. It's all going to go because the risk-adjusted returns are just not great. But if you do the same returns and you get a Sharpe of 2, for example, bite the hand off.
Impressive. Yeah.
Take it. Yeah. So the risk-adjusted returns is the number one metric for a potential investor to ask. So when we looked at ours, we were on, I think, 2.9 this year. I thought, great. To be a good hedge fund, you need to be above 2. Then all the rest is just down to our investors, it's down to me. Because if I'm on a Sharpe of 2 and it's been consistent for a good few years, you might say, look, Komey, can I make a bit more money? Like, yes, here's the max drawdown will go from 15% to 20%, but then you should get X amount. But the Sharpe remains the same, so the equity curves look good and smooth going up. You just make more money, applied a bit more risk. So yeah, Sharpe ratio, risk-adjusted returns. We always look
super important.
It's super important. The reward is just a side effect of good risk management, and that's how I approach it. So I look at the downside.
I love this. Yeah, love this. The reward bit is the consequence of doing a good job protecting people's money, and actually you then get paid. They get paid because you've protected it well, which I think is very rare in this market. And one of the things I'm going to ask you about, because a lot of our clients, a lot of people listening to this, either don't know how to trade, have no inclination or time to learn how to trade, because let's be honest, it takes a lifetime to be able to be as good as you are. It's not something you can just be successful at. You lost for 2 years straight, right? So a lot of people will be looking in the market and thinking, where can I put my money where it's safe, that I can get good returns or better returns than, there's a lot of property people at the minute selling, thinking, where can I put my money, etc. How can people go about selecting the right fund? Like what would you recommend people should look for other than the Sharpe ratio, which you've explained? What other things should people be looking at if they are deciding to get someone else to manage their money for them?
If they're getting someone else to manage their money, okay, so initially what I'll say first is become an investor yourself. So self-invest, because when we get our clients on board, it has to be institutional clients, it has to be high net worth clients, and these be people who've already been in the space. So even if you are to do an ETF type fund or something like that, put a couple hundred in there, invest yourself so you can see what the market does and understand it. Now, if you're going to a fund, so you've got your own little pot, it's going to be slow because S&P will, indexes will do 10%, 12%. You might go crazy with QQQs or triple Qs, like T triple Qs, which are, that is a leveraged NASDAQ. If you've got a crazy, I don't know, healthy appetite for risk, that would get you your 80% a year kind of thing, right? So nuts. But if you're going to a fund, you need to have what you call a DDQ, a due diligence, a client due diligence questionnaire. So I would make sure that the fund hands you the due diligence questionnaire. Now, what this does is it will tell you everything about the fund. It will tell you who the trader is. It will tell you who the administrators are, who's the risk managers, who does the oversight of it. What is the strategy? What instruments do they trade? What's the average win and losing months? It will tell you everything you need to know about the fund. So it's a DDQ, due diligence questionnaire. So that's number one. I'll make sure that it's got that. When you see that, you should see that they've got fund administrators. So for example, we've got a separate administration team that looks at our performance. We've got a separate anti-money laundering officer who comes in. We've got a risk manager who actually looks at my stuff every day. So you have all these things which should all be in that document. That's a very, very important document to look at if you're going to give it to an institution or someone who's not friends and family. Because friends and family is probably like, oh, I'm good at this, let me do it, right? So they've got nothing. But if you're going to go proper, you must see that. Also, you must see regulation. You must see regs from a tier 1, tier 2 type country. So Australia, UK, America, tier 1, Europe, most parts of Europe, tier 1, but then you have some places that are not quite tier 1. So like maybe it was in Vienna. Vienna's okay, Malta's okay. They're not fantastic, but they're good enough. They're good enough.
Okay.
But so tier 1, tier 2, and then you have the
Wild West.
Offshore. You have the offshore guys. Yes, that's normally, you see. So with Zentra, we started off going with BVI, which was British Virgin Islands, and the reason is people want to be tax efficient. And they want their money to be out of the country. So we thought we'll set up that entity for that. But when we're starting out, because we just launched this year, when we're starting out, it's okay. It's okay for an incubator fund, for a small fund, for just building up track records. It's all right, but it's not the best. So we had to go and get, and this is where literally a stone throw away from signing the deal for ASIC. So that's in the process. So we're going to have tier 1 regulation probably within the next month. It's been ongoing. I've just been through a full audit and all that kind of stuff. And probably the next month wouldn't have ASIC. So number 2, I'll make sure that they've got some kind of regulation, and they should have a third party overseeing the trading. Because what you find is if you're to give your money to someone or a company, at some point it goes to zero. And they will have some funky excuse for you. I was drunk, someone hacked my
That happened to
account.
me.
Yeah, there's gonna be something, some excuse, which in my experience, it's just bad risk management, and the system just failed. They had a robot that worked well, it stopped working, and then they had to come up with an excuse. So you would have something like that, and it nearly almost fails all the time. So I'll make sure that they've got that structure in place. And the final thing I'll look at is the max loss. The max loss that they are saying they're going to achieve, and can you accept that loss? Am I comfortable with that? If the answer is yes, I live as though I've lost that money. That's it. Because if I do lose the money, they've got, third parties looking at the account. So if it's 20%, 30%, 40%, whatever the number is, and it hits it, and I'm 40% down, can I take my money back and say, all right, I'll go against someone else, or whatever the case is? How would I feel at that point? And at that stage, people by people, am I comfortable with this person? Great. I'll then put in a test amount, probably the minimum that the fund requires, just to see how it goes. FOMO is, I mean, it still happens to me now, but FOMO happens to all of us. When we see a fund making money, we get excited and go going. I'll probably give it at least 2 quarters, half a year, just to see the live results before I fully commit. So yeah, I'll say those are the main things to look out for.
That's super helpful. Thank you very much. So let's talk a little bit about money generally. So have you ever done anything where you lost a lot of money?
Yes.
I know the answer to this, and you don't have to say what it is. But have you ever lost a load of money?
Yeah. I've lost a lot, and the first time we started managing money for people, and again, they didn't do any of what I've just said. They just said, "Oh, I know you guys. Let's
Here's some cash.
Here's some money." And at that point, we raised, probably as a team, there were a few of us trade. We raised about £250,000. And remember, this at this point, the most I've ever seen is probably two grand, £3,000 at any one time in an account. And now I've got 250K. So I've always been quite chilled, quite laid back, quite humble. And when I saw that money, I got so excited. I thought, oh, I hope money doesn't change me. So I started buying books on Buddhism and trying to just learn how to stay humble, right? Because it was a lot of money. And we were trading that for our clients. And one night, I wake up really early. One night about 2 a.m, a friend texted me saying, "Is my account supposed to be 50% down?" I said, "No, I've got a cutoff at 30%." Because I was running algorithms at the time, and the algorithms cut the trades off. So we were down about 7%, and it cut the trades off. And so I switched it off. And then I had a phone call say, "Are we supposed to be down?" And because a few of us had access to the accounts, I was calling everyone, trying to wake everyone up in the morning saying, "Are you trading? Are you trading?" And we ended up losing close to about 80%. So that 200K went down to about, 50K, something like that. And now, naturally, because this is friends and family, the next morning my phone is just ringing. And remember, I had a day job. So, that was tough. We'd lost pretty much everything, and it's a very, very uncomfortable feeling. Really uncomfortable feeling. But I just told everyone, look, just leave it with me, and I'll make everyone whole again. Because the one thing which I would say is, if we agreed a max loss, that's the max loss. The rest is on me. So yeah, it was a tough other 2 years, but I had to make sure.
if that's happened, so obviously people that are listening to this will be starting their investing journey, starting to trade, starting to buy property, even starting to look at gold and other asset classes, even crypto, right? When you've had a loss like that, how do you mentally and mindset wise come back from that? Like, how did you come back from that to be like, I'm not going to quit, I'm just going to figure it out?
Yeah, so the good thing with that loss is it wasn't something that I had done for the money to disappear. We were a team, so I think we had other traders who just went a bit crazy, wanted to make money and ended up being on the wrong side. So that was a good thing with that loss. But as a trader, when you do suffer a loss like that, the number one thing you need to do is to reduce your risk even further. So you would find people would do the opposite. They'll try and chase the money back. Like, oh, it's had a loss. And they'll try and chase the money back. The number one thing to do is just to reduce the risk. So that's how I came over it, because for the next year, I was trading at a third of the risk that I'll normally trade. And just to build that rhythm back, to get that cadence back in my trading. And then I was able to start increasing risk once I was comfortable with things, to be able to get back to normal. But number one is you have to reduce risk. If you're an investor, the chances of meeting someone like me back when I was doing it for my guys is slim to none. So you would just have to brunt that loss. What I did was I worked 3 jobs. So I used to work at a call center in Bletchley, Milton Keynes. And I used to work at my day job. So I was working round the clock 24/7, sleeping in my lunch breaks just to get the money back to physically hand over to someone to say, look.
Which is rare, because most people, I mean, I've gone into 2 funds. So I've, again, for full transparency, I've put money in Komey's fund in the past. There's none in there at the minute, but he's traded my money before, and I've put money into other funds as well. And Komey's fund made me money and kept my money, and the other 2 I lost money in. And that the other 2 that I've lost money in, it was, your money's gone, the end, full stop. There was no discussion about it. And you know, I say to everybody, like you've just said, assume you'll lose it, be comfortable with that worst case scenario. And if you're comfortable with that, then that's okay. Like, it hurts a bit to lose it because no one wants to lose money, but it didn't destroy me to lose it. So it was a risk I knew I was taking. I was aware of it. But I think what's interesting is that approach to making people whole is not something that everybody is willing to do or able to do, capable of doing. What do you think is different about you to the general market of traders?
For making people whole, it's a character flaw. It's actually just a character flaw. Because I've been told this several times. I always put myself in your shoes, and that's just how I live. I just think, well, if you had done that to me, I would like you to at least do something to get it back to me. Even if it's, just try. And so I always just put myself in the other person's shoes, and I think, well, look, they trusted me with their money. When you're dealing with people that put in maybe $10,000, $20,000, $30,000, it's usually their savings. It's not just a piece of a larger pie they've got. So you're damaging them. You know, you're really hurting them. So I am just not built that way. You know, I'm trying to be a bit more, I don't know, narcissistic, more business-like, look, as business, but I definitely value the personal touch. So when that happens, I think, what would I do? What would I expect? Well,
it's the right thing to do.
Exactly. So I just do whatever I can to get it back. And at the time, the only thing I've got is hours, labor. So I just put hours into the job market and I got it back. And the interesting thing was 90% of them put their money back into the fund.
But that's because you always make such an effort to, like, communication, all of those things are so important to you. And, you know, I would put money back with you like anytime. We're looking at selling a house, Komey, so we might end up with a conversation in the not too distant future, actually. There's a lot of people selling houses at the moment. Thank you to Rachel Reeves. So what emotion would you say that you most associate with making money?
Making money has for me, it is just goals. For me, it is more the journey, right? And there's something which I was saying, the destination no longer becomes important. It's the journey. So my entire trading career, I wanted to be able to trade for a living, be able to trade for 10 minutes a day, and to live wherever I want. I then achieved that. And I'm living on an island. Things are great. Family life is cool. We're not extravagant, just coasting, pure bliss, working 10 minutes a day. Yeah.
Although if you follow Komey on Instagram and you look at where he actually lives, coasting's probably not the word most people would use. You're living in Bali officially now, right?
Yes. And the house was
in a gorgeous house, and it's still lovely.
Yes. So yeah, but it's just I was spending all day with the family, all night with the family, and just doing just daddy stuff. But I'm not designed not to achieve. And yes, I'm making a living. Yes, I've hit that destination, but the fun was in the journey. It was in the actually doing something. So last year or 2 years ago, I thought, let me teach. I don't like teaching. I do not like teaching at all. But I thought, let me help people let me help me 20 years ago. Let me help me 15 years ago. Because online with trade education, it's littered with a load of nonsense. Literally, 99% of people don't make money who you see online trading, right? They just don't.
The people selling courses, you mean? So like people maybe have one successful trade and they set up an online course to teach you how to trade, but they're not actually making money from trading. They're making money from selling courses.
From the courses, correct.
Yeah.
Correct. The only people who you see making money are the ones who are doing ETF investing, long-term, dollar cost averaging. They're the ones who do well in the long run.
Which is what I do.
Exactly. All the others pretty much lose when it comes to trading. So I thought, let me teach. Let me be that one person who people can come to and learn from. But the thing is, group chats annoy me. I had a Telegram. It's just the notifications get your nerves. Yeah, and I just didn't like that process. I liked the result of it because a couple of people say, "Yeah, I'm doing well now.
I've done well."
Helped a few people out with passing. Some people who weren't working are now making not like a part-time income to subsidize any other side jobs, and they're thinking, "Man, why didn't I do this before?" So I love the outcome, but I didn't like the journey. So that kind of, I just said, right, well, I need to do something. Then I went back to the drawing board. What do I love doing? I just love sitting in my dark room, finding out systems, building things, and trading. So I said, okay, I trade for a fund already. Let me launch my own fund. Rather than have third parties. I'll just do it myself. And yeah, that was a journey.
A journey.
It was a journey. I was in Dubai a few weeks ago, and I was with my brother-in-law because I'm trying to get him into the finance space. And just the headache I went through in Dubai. He said, "How do you do this?" I said, "Bro, you just have to roll with the punches. You're either coming from a problem or going to a problem. Either way, there's a problem coming up. So you just need to learn to deal with it." And so he tasted a little bit of it, but he also tasted some of the pleasantries of it. So I met some other businessmen, some other guys who run funds, and he saw the lifestyle and just opened his eyes and he said, "Right, this is it
for me."
Yeah. So I launched a fund because
of the journey.
Of the journey, not because of the destination. The destination is going to be zero.
And it's interesting because so many people obsess about money and they obsess about the end result and they obsess about the destination and completely forget that there is a journey to go on to be able to get there. And actually your way of doing it gives you a different frame. As long as you enjoy the steps along the way, the end result will be the consequence. And that's quite refreshing, actually.
Yeah.
And clearly works for you, which is also good.
It does.
So,
it does.
Obviously, you went from school to job to being self-employed investor, etc. Now you trade other people's money. Do you think that we as a society, let's talk about UK, we're both in the same town, so we know what we've come from in terms of education. Do you think right now the education system is helping people to understand that these sorts of opportunities are out there and that money can work for us rather than against us, with debt culture and all of these things that's going on? Like, what's your thoughts on all of that?
I don't think the education system is designed. I think it's designed not to make us know about these things. I don't see why you would go to school your entire life, and I was there till I was 25, and I didn't learn about a balance sheet. I didn't learn about taxes. I didn't learn about investing. I didn't learn about businesses, running businesses. The core fundamentals of money, saving, budgeting. I didn't learn that. I didn't know how to split my money up. I just thought money comes and it goes. So I think it's designed for us not to. And in a capitalist world, the big players want us to spend. they need us to spend. So they won't push any new narratives in. If I knew, and I'm sure most of us would be in the same boat, if I knew now what I knew then, or if I knew then what I knew now.
What do you know?
It would be a complete, as in, I would have been retired at 30.
Yeah.
Right? All these bull runs, everything. As in, we'll all be in a very, very different place. I think the education system is archaic. I think it's built for dinosaurs. And now with the evolution of AI, I think people are learning to do jobs that are no longer going to exist in the next few years. So when it comes to money, it's failed. That's an epic fail. It took me self-learning, age 28, to start understanding about trading, which was just making money, but I still didn't know how to manage money. And that was at age 35. I think I'm making a lot, I'm spending a lot, making a lot, spending a lot. But how do you
manage and keep it?
How do I keep it? And so, that was at age 35. So it took me a while, something that I should have learned when I was age 10. So now I've got my whiteboard here, my son. I'm teaching him from now how to spend properly and still have capital growing for you. So I'm just trying to indoctrinate them for these things. Just that and networking, social skills. Those are the main two things that I'm going to pass over. This is how you connect with people, because people buy people. This is how you work with that. And this is how you manage money, because the school will not teach you that. So you have to chance for it.
So, I mean, I could sit and chat to you all day long. You know, I love talking to you anyway, because you're just such good energy. You're so easy to talk to. But we have to wrap things up at some point. So, couple of things. At the end of every episode, we ask our guests a question that's come from our previous guest. So I'm going to ask you that. The question that our last guest left you was, what was too much for the money? So was there anything you've ever done that was too much for the money that you got from it?
So I didn't get paid enough?
In your job? Well, not necessarily paid enough, but you either sacrificed too much, or you allowed boundaries to slip, or you didn't get paid enough. Like any of those things where you thought, do you know what, that just wasn't worth doing. That wasn't worth it.
Okay, so what have I done that wasn't worth it? I had there was an investment. There's an investment which I did where I entrusted in some people, and I put a lot of time and effort into building it. And I built I built a kind of segregated fund for them, and I put a lot of time, a lot of effort. Time is such a precious gift, especially when you trade 10 minutes a day to make a living. It's so precious, and I put a lot of time, a lot of effort into it, and it ended up just not being worth its weight in gold. So that, to me, that investment opportunity was something that just was not worth it. The time, the effort, me collecting all of my friends, my families, my closest pals to come into something and convincing them for it not to work, that was just not worth the money that I received back. And when I received back was, you get monthly income and stuff, but it just wasn't worth the money.
I think that's really interesting. Like, you are somebody who absolutely values time more than money. Even though you're someone who makes a lot of money, and you're somebody who manages a lot, makes other people a lot of money, it's really evident, even just from this conversation, but I obviously know you much better than this. Time is, in fact, probably one of your most valued possessions, one of your most valued things. And so actually, it's really, when people are looking at opportunities and looking at what they're going to do with investments, with business, with anything, I think the advice of make sure that from what you are giving up, not just financially, but also emotionally, time-wise, all of that sort of stuff should come into every investment decision.
Correct. That's right.
Really good advice. So the last thing to ask you is, we ask you to leave a question for our next guest. So you can ask, and you obviously don't know who the guest is going to be, so you can ask any question that you want to ask relating in some way to money.
Okay.
Fire away.
What the question I'll say is, what would you do if you no longer had to work for a living? If money was no object. If money was no object. What would you do? If I had that magic wand for you, and you needed anything, and I could just wave it and you had it, what would you do with your life?
Wow. Great question. I'm going to ponder that question myself, actually. Great question.
I ponder that all the time.
Yeah.
Here's the hedge fund.
Launch a hedge fund.
Yes, launch a fund.
Komey, thank you so much. If people want to get in touch with you, or they're interested in the fund, or just connecting with you on socials or whatever, how do they get in touch with you?
Just send me a DM, Instagram. Handle is at Komey T, KOMEY.T. Just send me a DM and I shall respond. We'll connect.
Amazing. Thank you so much for your time. Really appreciate it. I know these guys will have loved listening to that. So yeah, thank you ever so much.
Thank you.
See you later.
Thank you. Take care. All right. Bye-bye.
Thank you so much for getting to the end of the podcast episode. I really hope that you enjoyed it. I just wanted to take this opportunity to remind you that the weekly Money Mechanics newsletter is available to you completely free. This is a newsletter that I'm going to send out every week to just give you some ideas around what's happening in the markets, what's happening at a global level, what's happening at a lot more local level, so that you can better understand what you can do with your money to make it work for you for the future. I'm also going to share in the newsletter what I'm doing in my own portfolio, just to give you some insights into what my ideas are, why I'm making the decisions that I'm making, in the hope that it will help you to make those decisions in your own portfolios as well. All you've got to do is find the link that's with this episode, hit the link and subscribe, and that newsletter will start to come out to you every single week. I'd also really love to take this opportunity to invite you to drop me a review. I love the opportunity of getting to share these podcast episodes with you. It really helps me to better understand how we can do the best job that we can here at Money Mechanics if you tell us your feedback. So drop us a review, tell us the sort of guests that you want, talk to me and connect with me on Instagram, talk to us on YouTube, wherever you are hanging out. Tell us how you're finding it, and we can make this the very best podcast it can be. Thank you again for being such a valued listener. I appreciate you all, and I'll speak to you soon.